This is Cece. Welcome to the Orbit. It is Thursday, April 18th. We've got stocks basically unchanged right now. We actually slightly into the green as we start here. We are about 45 minutes into the trading day. That is after a couple of pretty ugly days, ugly action where we've seen the market try to open up higher to start the day, find sellers almost immediately, goes down, puts in new lows. It doesn't necessarily finish on those lows, but we have been finishing near those lows each day. Now, we are, of course, near a very important 5,000 level. And that is important not just because it's a big round number, but also a 5% pullback from the highs. As we mentioned in the Orbit email yesterday, closest analogy we have in recent time is going back last summer to at the end of July, we had this sell-off, and it ended up as being about a 10, 11% correction in the market. It's this area right here. And the way that played out is it was a very similar backdrop. It was rising treasury yields. You can look up the TLT chart from the time. TLT, when TLT goes down, that means yields are going higher and bonds are selling off. The VIX in that first downdraft went from about 13 to 18, which is very similar to what we've just seen. It then went all the way back to 13 on that little rally, that little retracement. And then when stocks sold off again, the next spike was up to about 21. And then we had that third wave where the VIX spiked up to about 23. And then that was the bottom. But at the same time, that is where TLT bottomed. And that's where treasury yields topped, right? So the market wasn't able to escape that 2 steps down, 1 step up, 2 steps down, 1 step up until TLT and the root cause behind the sell-off actually cleared. However, looking back at that history, we down 5%. We had 3 times in a row where the sell-off was about 5 or 6% before the market found buyers. And then those buyers failed ultimately because the root cause hadn't cleared yet. So that's what you want to have your eye on as a trader is, there will be rallies in this selling, and it's possible we're near one. But is it the big one? Was that actually it? Is it down 5% the correction, or does there have to be more pain to come? We don't know that yet, but you at least have a couple of things to look to. And USO is another one. Is oil basically, you look at this the last couple of weeks, and oil topped out here up at almost like the mid 80s, and we're back down below 80. That's another thing to keep an eye on. And as we tweet out, we'll say oil's down today, yields are slightly higher, stocks are unchanged. The most obvious contrarian thing on certain days is if you see yields lower, you see oil lower, and you see stocks open lower, that might be an opportunity where stocks rebound. If you see stocks attempt a rally in the morning, and then you turn and you look at TLTs down and you look at USO up, that might be a potential fade the market move in the morning. So that's sort of a little bit of a cheat sheet for you. I saw a joke on Twitter yesterday where somebody said, okay, so it's agreed we're all buying at 5,000, nobody cheat, right? So everybody's looking at this level, and you have to be aware of that when everybody is looking at something, it most often is somewhat self-fulfilling, but as that joke goes, it's like nobody cheat, meaning it's probably not going to be perfect that, when we do see buyers come in. Look at the 2-day expected move. Right now we've got it's actually almost still about 1% expected move into Friday. And let's just look at a credit put spread, 1,000 level. Let's make this like a 10 wide. Let's do a $10 wide SPX. Okay. So right now this is risking about 750 to make 260. If the market did get down to 5,000 today, this would be about much closer to a 1-to-1 risk reward. What would be an at the money credit put spread at 5,000 would be one way if you were looking to sort of catch that low or be close to that low. And as we mentioned, selling a credit put spread benefits a little bit from that high vol and the continuation of high vol if you're wrong and your timing is wrong, because it actually gives you a little bit that pumping of premium means your mark to market losses are less quick if you're wrong and you have time to take it off. We're less of a loss than if vol was low and it just went totally in the money and close to 100 deltas immediately and you were just dead wrong. As far as looking professional play, looking at QQQs, we're at about 426 right here. Let's go out like 1 week on this one, and a call spread, and let's go out till next Friday, April 26th. Let's just take a look at that kind of risk reward. And obviously, this is high volatility, as we've been discussing. This is a 10 wide debit call spread, and it costs about $400. So it's 4 to make 6. That shows you how high vol is. That would typically be at a lower vol level, that would typically be closer to 300 to make 700, maybe 350 to make 650. But in this case, that upside call you are selling that is extremely pumped vol. So doing any kind of directional positioning, and this is the same for put spreads, especially put spreads actually, because there is a lot of demand for some of those downside puts. Finally, after all of this time, people are actually buying some downside puts for protection. That means you as an options trader, you get to benefit from that. If you're buying a put spread, if you think this market's going down 10% over the next month and a half, you want to be selling that really far, or not really far, but the downside puts at the expected move or beyond the expected move for that time period, because you are getting rewarded with a high vol. And in this case, on the Qs, if you were looking to position for a rebound over the next week, even if it was one of those sort of 50% retracements like we were looking at from last summer, this would give you a break even right at about 430, not much higher. That could happen, if we saw the market reverse, that would happen in hours possibly. So, this is another way to look at when you are ready to try to position from the long side. This is one way to do it. Now, of course, we have no idea how this is going to resolve. We don't know. The market could go straight down through 5,000, but this is the way you look at it. And of course, as everything we talk about on the orbit, define risk. It's that credit put spread. You do it $5 wide on SPX. You do it $1 wide on SPY. You're wrong. You know exactly what your risk is.